Okay, it's 11 a.m, so it's time to get this show on the road. So good morning to you and welcome to this week's weekly show. James is on holiday this week, but we'll be back to entertain you next Friday. In the meantime, you've got me, Matthew Reed, and I'm going to be taking you through this week's news before bringing on this week's special guest, Jennifer Murner, who is co-manager of Aberdeen Income and Growth. As always, if you have any questions, please pop them in the Q&A or email them to me at mr@martinco.com. Beginning with the news, while sort of the country's politics have been quite noisy this week, it's all been pretty quiet in investment trust land, and pretty much can be said, the same can be said for the sort of REITs and property companies that we cover. Nonetheless, a few interesting things that have come up that sort of might have been lost within the noise, and I'm going to try and take you through some of those now. So the first thing that I wanted to cover off is the departure of Hamish Baillie from Ruffer. He's been there for sort of nearly, I think, or over 11 years now. So that's sort of quite a significant event for them. And then, well, obviously, Jana talked about the music royalty funds a bit last week. We've had some more good news from them this week. So I just wanted to go through some of that. The next thing I just wanted to cover off was Taylor Maritime's inaugural results. So this fund, the shipping fund, was launched back in May 2021, end thereof, and it's published its first set of results, which are basically the 10 months to 31st of March, and they're pretty impressive, and I think they're worth a look at. And finally, I just want to have a couple of look at some of the sort of unlisted growth companies, because there's a couple of interesting loosely related stories coming through there that are sort of worth having a look at. So first thing, Hamish Baillie stepping down from Ruffer. So he's leaving Ruffer after 20 years to pursue other opportunities. This has happened sort of quite quickly. So they only announced this on Tuesday, but he'll be gone by the end of July, which sort of tends to suggest that, for the guys at Ruffer, this has sort of been a bit of a surprise. He's obviously going to have to do something exciting, possibly in sort of competition with some of the stuff that he's doing already, which is probably why he's out the door quite quickly. Now, Hamish joined Ruffer from university straight from university in 2002, so founded their Edinburgh office in 2009, and probably for us the most significant thing is he's been manager of sort of Ruffer investment company since October 2011. Now, I think the sort of key takeaways for us is that obviously Duncan McInnes, co-manager since September 2016, so they've worked together for sort of nearly 6 years now. Will be continuing at the helm, and I think all of their processes are very well embedded. It's sort of very much a sort of team approach there, so it's sort of hard to see that there's actually going to be sort of much change there. So I don't think there's a sort of great deal to worry about. They've not said whether a sort of search for a new manager is underway, but I would have thought that if they don't find somebody externally, that somebody else will be sort of brought up into that position. If you have a look at the sort of share price which we have here, as you can see, market seems to have sort of shrugged it off. So share price fell, just under 0.5% on the day, and actually the NAV fall exceeded that. So really not a lot to worry about. Moving on, talk about the sort of music funds. So last week, Jana talked about the sort of US copyright royalty board ruling and how this had been upheld, and actually how this was good news for the likes of Roundhill and Hipgnosis songs. I'm not going to recap that in sort of great detail. The sort of key takeaways were that royalty rates for writers or songwriters and publishers are going up sort of quite significantly. This is backdated to January, but say you can see last week's recordings for more details of that. This week, sort of 3 things have happened. The first is that Roundhill has announced that it is going to apply to move up from the SFM to the LSE's main board, and there's some other things it's doing around that. And also Hipgnosis has come out and said that it's signed some new administration agreements that are going to help it collect sort of royalties around the globe. It's also had a set of results out, and there's almost 10% NAV uplift in those, so we're going to have a little look at that as well. So first of all, if we talk about Roundhill, let's say it came out this week and said that it is going to apply to move up to the main board. There isn't a sort of timeline for this just yet, but I think sort of broadly speaking, this is good news for everybody. So it currently trades on the specialist fund market. In moving to the main board, the idea is that it's going to sort of broaden the appeal to a wider range of investors, and it should make it more accessible Obviously, professional investors can readily get access to the SFM, and it's not impossible for retail investors to sort of do that, but it is trickier, and there tends to be sort of more hoops. We've long bemoaned this, but we tend to argue that most funds, rather than being higher risk, actually are inherently diversified. But anyway, let's say if it moves up to the SFM, so it moves up to the main board, that's going to make it easier to access. Another really nice thing is that they are planning to introduce a sterling quote alongside the existing US dollar quote, which almost certainly will make that a bit more accessible for a big chunk of UK investors, particularly those in the retail space. The interesting thing is that they say it's currently sitting on nearly 11% discount with a yield of almost 4.5%. If you sort of look, let's bring down the next slide, you can see that really the NAV has held firm so far this year. The sort of chunks down are basically dividends, etc. Yet the share price has come off a lot in recent months. So if these moves make it more attractive, then actually that could actually help close up this discount a bit. So food for thought there. Now, sort of talking about Hipgnosis, this has signed new administration agreements. The first is with SACEM, which is a direct administration agreement. Basically, SACEM is a Paris-based CMO, so collective sort of management organization, and it has very good technology for collecting sort of rights. So that's going to expand Hipgnosis's reach in terms of actually collecting royalties, because you know there are a chunk of these that go missed. I think it has some particularly good reach into getting mechanical royalties, which can be harder to access. Similarly, it sort of signed a publishing rights agreement or administrating agreement to collect publishing rights and other royalties for the rest of the world, excluding the US, with an outfit called Peer Music. Once again, these guys have got more tech that allows them to get into sort of far flung places and collect these rights once again, a lot of which can go sort of overlooked. However, Hipgnosis will continue to collect the US side of the royalties, as they're very well set up to do that. If we look at sort of Hipgnosis's annual results, key thing here is actually a fairly decent uplift in NAV, almost 10%, so 9.5%, which has been driven largely by like-for-like valuation uplifts across the portfolio, which is obviously independently valued. Key drivers behind that are strong like-for-like streaming growth of 19.4% in the second half of 2021, which was ahead of the valuation or valuers' expectations, and they have increased their sort of figures for subsequent years, basically. The other thing is they are seeing increased revenues coming from the emerging technology platforms, and they're saying these are becoming increasingly material. And once again, that has been factored, and obviously that's built in over the long-term assumptions. Next thing I want to look at is the table Maritime results. Now, the sort of thing to say, I think I said in my opening gambit, is these inaugural results cover a 10-month period. Basically, the fund, I think, IPO'd on 27th of May 2021, and obviously these results are the 31st of March 2022. So you're looking at a 10-month period, and they are singularly impressive. NAV total return over the period 81.3%, share price total return 45.5%. I'm not saying it's possible that you wouldn't see this again, but you don't tend to sort of see, an opening set of results like this. I thought it was worth talking about, particularly as this is probably a less well-known fund. And these kind of results are going to increasingly put it on people's radars. What I wanted to look at is sort of where the sources of that have come from. So, key takeaway: profit before tax for the year $253 million US, and that breaks down 79 million operating profit and 174 million fair value gains. I'm going to come back to that because that particular point is sort of quite important, and it reflects the way that they actually manage this portfolio, and I think that's probably not that well understood. But just to give you some sense of scale, TMI IPO'd in May 2021. It raised US dollars 254 million. Now 160 million of that was fresh new cash. 95 million was effectively in consideration shares because there was a seed portfolio that went in. The great thing about that was because it was a sort of mature portfolio, this thing was basically generating cash from day one. And there was a little bit of a top up in July 2021 when it released another 75 million US dollars there. But probably one of the interesting things is its sort of profit before tax during this 10-month period has pretty much covered the money that it raised at IPO, which is quite astounding, and that is reflected in the scale of returns for this year. Now, as I say, I just wanted to talk a bit more about what this actually does, given its spectacular results. It is a sort of shipping company. The CEO is a guy called Edward Buttery. He comes from, his father was a shipping magnate. So he comes from, a well-known shipping family. They've sort of been doing this for a long time, been very successful at it. What Taylor Maritime does is it buys second-hand vessels. So it's generally not buying new stock, but it's shipping company with a diversified portfolio of predominantly second-hand vessels. What they do is they are targeting vessels that they think are, undervalued, effectively trading at sort of high yields. So they want things that are going to give them a yield in excess of their 10% dividend yield target. They're quite explicit about that. And they will tend to be buying these when perhaps they're a little bit out of favor, but they can see the potential day rates to appreciate. That will drive up sort of capital values and yield compression. They acquire these things at below average prices. When they sell them, they can lock in a decent capital gain. And I think this is the key thing, and perhaps this differentiates it a bit more from Tufton Oceanic, is that it's not just a buy and hold strategy. They are sort of very active in the way that they will sort of buy and sell these ships. They're certainly not afraid to sell them. Just to give you some sort of sense of scale, since IPOing, it now has a fleet of 31 vessels. Total market value for those at 31st of March was 546 million US dollars, but 66 million of that is for assets that literally are up for sale. So once again, just to give you some sense of the way the portfolio is made up, average fleet age is 11.4 years, or it was as at 31st of March. The sort of key takeaway around that is, once again, this is not brand new vessels. These are sort of moderately aged. When you think that some of these vessels are going to have an active life of probably at least 25 plus years, there's plenty of value left in there. Give you some idea of where the sort of value has been created this year, at least on the operational side. There has been a big uplift in the day rates in sort of certain sectors. I mean, it's quite clear. I think in oil and gas, etc., following Ukraine, or the invasion of Ukraine, but actually there are other segments that have seen hefty increases in day rates too. So give that a sort of sense of scale. When, or at the 31st of May, take an average across their portfolio, the average day rate was 18,600 US dollars per day, and that was up from 15,600 9 months earlier. Things that make this attractive is it pays quoted dividends. As I said, it's LSE main market listed. It has a US dollar quote and a sterling quote, and paid a dividend of basically 8.5 cents, which was around 10% yield on the issue price. So once again, those two decent profits are coming through now. The interesting thing is actually discount has opened up on this. So when I was running this, it was 23.4% discount to NAV. One would guess that is largely on recessionary field. So, global economic slowdown, generally less trade, generally less sort of demand for ships, but actually both through a combination of increased environmental regulations and obviously pandemic, a lot of tonnage has been sort of taken out of the market in various sectors because it was just uneconomic at that time. So a lot of scrappages were brought forward. And people weren't putting on orders for new ships. So actually, a lot of the high day rates that we're seeing at the moment are probably going to persist for some time, even if we do get, a slowdown of sorts. As I say, just to illustrate that point, the NAV in this chart, as you can see, it's the green line at the top, it's holding up well, but the price has come off a lot. So you can get this chunky yield, protect or potential for capital growth, and you can get it at a reasonably sizable discount. One thing I did want to cover in talking about this is obviously its ESG credentials, because as we well know, shipping tends to be a sort of fairly dirty activity. Now this has been improving. You're seeing ships increasingly run sort of using gas rather than sort of dirty oil, and they did tend to use sort of dirty oil to do this. They have set a commitment to achieve a long-term target of zero carbon emissions by 2050. However, they do say that to achieve this, substantial technological advances are required, and that's a sort of key thing for the shipping industry in general. However, they have clearly defined near-term initiatives, which are basically sort of vessel modifications, primarily retrofits, because as we said, they've got second-hand vessels. They are speaking with the owners, the lessors of their vessels, and trialing lower carbon fuels, and they are introducing other energy-saving methods on these ships. Last thing I wanted to sort of talk about was obviously what's happened with some of these unlisted sort of tech holdings. And there are sort of two that I want to talk about in relation to this. One of them is sort of wefox, which is a Chysalis holding. Now, as we know, sort of Chysalis has had a torrid time of it, both as a combination of sort of growth selling off, plus there's been some negative sentiment. We paid a sort of fairly chunky performance fee just before the market rotated back to value, which was on sort of realized gains, and that has not gone down particularly well. But I think what's happened with sort of wefox this week is quite illustrative in terms of where actually value may come back. So wefox is a Berlin-based insurtech platform. The sort of insurance market in Germany, they don't tend to have the sort of price comparison sites we have here. They're sort of behind the curve in that way. So it's sort of less competitive market. It's more like the sort of old broker model that we would have seen 20, 30 years ago, where you'd go to a broker to get your sort of car insurance or house insurance or whatever. And so wefox's platform plugs into that, and it's able to identify what it considers to be sort of particularly attractive risks, and then it can sort of price them accordingly, and actually keeps a chunk of the book for itself. So it has been a successful and profitable sort of venture for them. Now it's just done, I think, a Series D funding round, which is a combination of debt and equity, which I think was about 400 million US. And basically that values the sort of whole business at about 4.5 billion. But 12 months ago, when it did its Series C, it had a sort of post-money valuation about $3 billion. So this is around a sort of 50% uplift in 12 months, which is quite interesting at a time where a lot of growth investments have been very much going the other way. Now, Chysalis did not participate in this because it's already a chunky holding for the fund, but it does underpin the sort of current valuation. As I said there, it's still Chysalis' the second largest asset and 13.3% of the portfolio. I think the sort of key takeaway, and I'm going to come back to this, is that not all growth is sort of high cash burn indebted companies. wefox is a sort of very profitable output, and certainly part of Chysalis' modus operandi is to have a view as to what where there is a path to profitability, where it's investing in these things. So I think it might provide some sort of illustration of how the assets may recover, and given the way that sort of growth has gone and given the negative sentiment, you can invest in Chysalis at a 56% discount at the moment. And as you can see there, and the NAV, this is sort of taken from Morningstar data, maybe a bit out of date, but there's quite clearly a lot of headroom. Final thing I wanted to talk about, which sort of relates to this, because this is another illustration of what might happen with sort of certain unlisted growth companies, particularly let's say those that are cash generative, is what's happened with sort of Town Centre Securities with this week. So in addition to its sort of property portfolio, Town has got, or has, an equity investment in a parking app called Your Parking Space, and it has sold this to Flowbird SAS for 20.7 million sterling. Now, the sort of really interesting thing about this is actually this stake was held on its balance sheet about 1.47 million. So this is a huge valuation uplift. To sort of give you some idea of what this app does, it sort of connects drivers with sort of, they say, 350,000 privately owned and commercially operated car parking space in the UK. So you can book these in advance, so monthly, weekly, hour, etc. But once again, it is significantly cash generative, which sort of shows you the value that you can generate if it is a growth company, but there's a sort of clear path to profitability there. In terms of what Centre Securities has got out of this, it's got 9.6 million cash up front for selling its equity position, and it's going to get another 7.5 million deferred, 4.5 million 12 months after completion, 3.1 after 24 months, and then it could get a further 3.6 million depending on how the business performs over the sort of subsequent 14 months. As I said, to the final point there, not all growth is high cash burning debt companies, so something or food for thought, as it were.